Hello students and welcome to this very important and interesting lesson series from the chapter Accounting for Share Capital. Company is a term which we use frequently in our everyday lives. Now this term company from the accounting point of view needs a thorough understanding. Remember, we read about company form of organization in our video lesson series on the forms of business organization. Today we will learn the concept of company in all details. Everything begins with the capital here, or to be precise, in any form of business. While any entity grows, or maybe at the inception as well, the capital is contributed by a large number of contributors, technically called shareholders. The capital contributed by shareholders is called the share capital. Our lesson series is all about accounting the share capital. Now, what do you think are the features of a company that distinguish it from other forms of business organization? Let's see. Body corporate, separate legal entity, limited liability, perpetual succession, common seal, transferability of shares, can sue or be sued. Now, let's quickly have a look at the broad categories of companies. Classification can be made either on the basis of liability of the members or the number of members. On the basis of liability of members, companies can be divided into companies limited by share, companies limited by guarantee, unlimited companies. On the basis of number of members, companies can be divided into public company, private company, one-person company. Now, let's understand these all in further details. In case of companies limited by shares, the full payable or liability of the shareholders is limited to the extent of nominal value of the shares held. For companies limited by guarantee, the shareholders guarantee an amount to be paid in the event of the company being wound up. Unlimited companies are those which do not have any limit on the liability of the members. In case the company is being wound up and the company's property is not enough to pay off the dues, the shareholders' personal property can be used for payoffs. And now for the other bucket. Let's see the details. Public companies are companies which are not private companies or subsidiaries of private companies. A private company is a company which, via its articles of association, must have at least 2 members other than one-person company, restricts the right to transfer the shares, limits the number of members, that is, the shareholders, to 200. A one-person company is guided by the provisions of Section 2, subsection 62 of the Companies Act 2013. Rule 3 of the Companies Incorporation Rules 2014 lays out a few conditions for a one-person company, popularly known as OPC. Only a natural person who is an Indian citizen and resident of India can form a OPC. It cannot carry out any activity specified as non-banking financial investment activities. The paid-up capital cannot exceed Rs 50 lakhs. The average turnover of 3 consecutive financial years immediately preceding the financial year does not exceed Rs 2 crores. Well, now we come to the share capital of a company. From the accounting point of view, the share capital can be classified into a few broad categories. Not only for understanding's sake, but also for the purpose of applicability and proper disclosure in the balance sheet, you must learn them properly. These are authorized capital, issued capital, subscribed capital, called up capital, paid up capital, uncalled capital, reserve capital. Authorized capital is the amount mandated or specified by the Memorandum of Association or the MOA, and the company can issue the capital, to be precise, can raise the capital amount only till the threshold of the authorized capital. However, this is only the upper cap, and the company need not issue the entire authorized capital at one time or at any point of time. In case the authorized capital needs to be changed, the MOA needs to be amended with the specified amount. The authorized capital is also called the nominal or the registered share capital. Now, issued share capital is that portion out of the authorized part which is issued to the public for subscription. This also includes the shares allotted to the signatories of the memorandum or to the vendors. Means the entire issued capital, be it to anyone, should be considered an issued capital. Subscribed share capital is that part of the issued share capital which is actually subscribed, meaning to say sold in simple terms. Suppose 1 lakh number of shares at the rate of rupees 10 per share are offered to public for subscription. So, here the issued share capital is rupees 10 lakh. Say 70,000 number of shares are subscribed, so this would be the subscribed share capital. Now, instead of 70,000, number of shares subscribed stands at 1,20,000. Is this possible? No, because the issued share capital is only 1 lakh number, and in this case, the subscription should be stopped at 1 lakh. However, say the number of shares subscribed stands at 80,000. In this case, the subscribed share capital should stand at rupees 8 lakh. So, remember this rule forever, students. Subscribed share capital can be equal to or less than the issued share capital and not vice versa. And with this, we will have to close our lesson for today. We will understand the remaining categories of share capital and many more in our remaining video lessons. Till then, a very happy learning.